And on today's show, long-term care, part 4 of this week's series of Final 4 product review with long-term care expert Maria Sarci. Hi everyone, I'm Steve Savant, syndicated financial columnist and contributing author to Backroom Technician in Innsmouth. Let's get down to business. Well, welcome to the show, Maria.
Thanks for having me, Steve. I'm glad to be here.
I'm glad that you're here, and we're talking about long-term care
Yes.
and heavy emphasis on care. And we're going to talk about some of the standalone, because a lot of people are kind of used to hearing about annuity with LTC-linked benefits and life insurance with LTC-linked benefits. Well, let's go completely morbidity today and talk about long-term care. When we're talking about it, they don't have a big inventory here.
Well, I would think twice about saying there's not a big inventory because the long-term care market itself has really never been as robust as it is today. The solutions available, as you mentioned, the annuity and the hybrids, well, they're part of the landscape now that makes up long-term care planning. The standalone solutions, pure morbidity, as you mentioned, in that space, you're right. The number of carriers in it are not as many today as we saw 10 or 15 years ago. But the carriers who are in it, completely committed, true pioneers in this industry, and are coming out with innovative products all the time.
Do I need to look at carrier ratings when I'm talking about long-term care claims paying ability?
I'll give you my opinion in that looking at carrier ratings is something that every policyholder should do in the research and development phase when they're selecting their carrier, and also continue to look at as their policy owners themselves. The carriers that we work with are primarily A and better rated carriers. And those are the carriers, and I mentioned 4 here to start with. We have Transamerica, Mutual of Omaha, Genworth, and John Hancock. Carriers that have been in the industry since the late 1980s, Genworth since the early 1970s. So a lot of claims paying experience, highly rated carriers, and in my opinion, where I'd want to focus my attention.
So we have a history with these carriers on, are they good claims paying companies?
Yes.
And apparently, since we're still selling them, they must be doing a good job.
Yes, you know, and when you think about claims, that's where the rubber meets the road, so to speak. It's why individuals go out and look at these policies in the first place. And so when you're dealing with big players, such as the 4 I've just mentioned, they've had the experience, they have the intelligence to go back to the marketplace and look at how they can even fine-tune that process as they go along. And occasionally you'll hear folks talk about, well, this carrier didn't pay this claim or they didn't pay that claim. And I will caution that when you're in a claims paying scenario, all of the documentation needs to be correct. The carrier will work in partner with the policyholder. And if it's a valid claim, payment should be there.
In standalone policies, not linked products, are there different types of long-term care?
What do you mean?
Well, do we have different, is it just pretty standard? Is there a pretty standard chassis now for basic contracts? So what do I look for as an agent?
Great question. And so in the standalone solutions, today you really have one type of model, and it's called reimbursement. And what that means is that
no more indemnification.
not in the standalone space.
Gotcha,
You'll
okay.
find that more in the hybrid solutions, the life with the long-term care, the accelerated benefit riders. But in the standalone concept, which is what we're talking about today, primarily reimbursement, which means if I, as a policyholder, have a benefit period of $6,000 a month and my bills amount to $5,000, $5,000 is what I can expect.
So I have to actually bring that receipt to the carrier.
Yes.
And so I have to prove use.
Yes.
When I'm talking about this, there's different, when I talk about prove use, there's also this level of different care. I mean, it's so I really need to think about, well, I'm going to be reimbursed based on my contract and what level of care I'm getting. Talk a little bit about level of care.
Well, as our society has matured, we've seen levels of care actually increase. For instance, 20 years ago, assisted living facilities were not nearly as popular as they are today. As our society evolves, as the demand for care becomes more and more, we're finding support not only at the facility level, such as in a nursing home or in an assisted living facility, but home health care is actually the #1 way individuals today receive care in this country.
Do you see the boomers changing the map on types of care or levels of care?
Without a doubt. And we've never seen a generation of this size in our country before. And they are a generation that's been very educated on care. They've been a generation that's provided care to their loved ones. And so they are thinking of ways in which they can live more independently, which they can really live on their own terms. And so yes, I do believe that we will see more possibilities for care in the years ahead.
When you think of constructing a good contract for your client, I know the benefit period's probably one of the first things we do when we're tinkering with the chassis. what am I looking for? What am I trying to accomplish?
So I'm going to take a step back, if I could, before I get right to the benefit period and all of the policy options, if you will. What our experience has shown is that each client has a very different picture of what their later in life needs will be. And everyone has a very individualistic approach to how they want to live life on their own terms. So when doing a plan design, it is important to ask what the needs and desires are of that client. Where do they want to receive care? If they live in Arizona today, are they thinking about moving to New York City to be closer to their children? All of those factors come into play because as a long-term care specialist, we should be able to respond and provide the right benefit options, years of care. Somebody interested in a 2-year benefit period or in a 10-year benefit period. We want to look at how much coverage per month, and all of those things can be really individualistic and quite honestly, part of our responsibility to show clients what's available in today's market.
When we come back from the break, we're going to continue our expose on long-term care, part of our final 4 tribute to the product review. And I really want to concentrate on things that we're building a good contract. And when I think about advisors, do we even know how we want to live? I think that's kind of, sometimes we don't even know the answers to that. But we're going to get some of them from Maria right after the break. Back in the day, life insurance professionals were called field underwriters. Then, carriers trained their field force in the basics of life insurance underwriting. Today, the insurance industry doesn't educate the agent population as they once did. But now you can have the Informed Risk Guide at your fingertips so you can illustrate a reasonable rate class for your life insurance prospects. Just request your copy of the Informed Risk Guide at downtobusiness.ashbrokerage.com. It's free from Ash Brokerage, the practice enhancement company. Welcome back to segment 2. Of course, we're with nationally recognized long-term care expert Maria Sarci. Maria, we talked about 4 top-of-the-line standalone LTC contracts. You named names. But they each seem to have a forte or an area of expertise or an area where their contract leans a little bit different than the other one, their interpretation. Why do you choose one over the other? Give me kind of what you think are some of the expert areas or their little areas they have good features on.
Yeah, great question, Steve. As we work with clients, we often hear about selection of which carrier do you think is the best. And so as I said in the last segment, it's really about identifying what's important for that consumer. What are they really looking for? So I'll go through these 4 carriers that we've talked about and identify or highlight one component that really helps them to stand out over some of the others. And ultimately, the client will choose which of those solutions is most important to them. And so I mentioned Transamerica before. I will start with Transamerica first. Transamerica offers a built-in 0-day waiver of elimination period for in-home care, which means that once a client goes on benefit in their own home, they don't have to wait for their benefits to begin. It begins at day 1. There is no elimination period.
That's distinct.
It is. And they also offer a 5-year rate guarantee, which means that once you purchase one of the Transamerica policies, you can hold on to it for a period of 5 years without any adjustment to your premium. So key factors about Transamerica.
I love that 0 benefit time. I think that's huge.
Yeah, and it's meaningful to some individuals, especially if they don't have the means to cover the costs out of pocket during what typically is a 90-day waiting period. If we take a look at Genworth, well, they have been the pioneer really in the long-term care industry, riding it since 1974. Some of their care coordination support is the most robust in the industry, which means that once a person goes on claim, the policyholder and their family actually have access to a whole host of resources that help them pick and choose service providers, care providers. Individuals will come into the home and assess their situation. So a very hands-on approach at claim time that really stands out with Genworth.
And that's different from like the other 3 or 4 that you've mentioned?
Well, the other 3 or 4 carriers also have it, but Genworth has the most robust and they've been doing it the longest. So when I think about the Genworth solution, their experience since 1974, where the other carriers came into play in the late 80s, certainly says something about Genworth.
Wow.
Yeah.
How about another one?
Mutual of Omaha. They have a unique feature called a cash benefit feature, which means that if the individual should choose, and that example I'd given in the last segment of $6,000 per month, if the client wanted to, they can take a portion of that $6,000 as cash to really spend it any way that they see fit. So instead of that reimbursement, submit bills and cover your costs that way, Mutual of Omaha offers a feature that gives the policyholder an opportunity to take some of that monthly benefit as cash and spend it as they'd like.
So there's a certain cap on that, and they can use it in any way. Once it's gone, then they have to do the reimbursement and
Correct.
whatever is appropriate to match up to the contract.
That is correct.
Okay.
Yep.
Okay, and then do you have anybody? You had one other one.
I do, John Hancock.
Yeah.
And so John Hancock has done some really innovative things with their inflation solutions on their contract. They're actually the first carrier to come to market with a CPI inflation option. One of the things that brings the premium up in a standard long-term care solution is your inflation option. And the higher or the more robust the inflation solution, the more expensive the premium. So John Hancock has developed a CPI, Consumer Price Index inflation, which is nowhere near the 4 or the 5% that's offered by some of their friendly competitors, and it helps us to adjust the premium for a client who's really looking for a less expensive solution.
Have you seen in your experience the people choosing a more aggressive COLA or cost
Absolutely.
rather than do the CPI, which doesn't even have groceries and gasoline in it?
Again, it's personal choice, Steve. So if we're sitting down with a family and they are in their early 50s and they're really concerned about what cost of care will be 30, 35 years from now, they are looking for something that's more aggressive by way of a cost of living adjustment. If we're talking to clients who are in their late 60s, early 70s, they have a little bit of a different mindset. They're not as interested on the cost of living adjustment because their horizon for needing care is a lot closer.
Have you seen any of our long-term care carriers? Do they give any kind of one-time lump sum payment to satisfy their long-term care? Do they do a 10-year, or is it just continual pay?
Well, about 3 years ago, we had a lot of single premium and even more so in the 10-pay arena. But now these long-term care solutions, standalone, are paid for annually for the life of the contract. We don't really see any short pay. That adoption has really moved into our linked benefit model.
So we're really doing annual premiums.
Yes, we are.
Now, when we do that, is there flexibility to pay by the month rather
Yes.
than annually? And
Yes.
is there a price tag for that?
Well, the more you spread out the payments, yes, the more of a cost it can be. And so paying it annually once a year is probably the most cost effective if you're looking to save on some of those financing charges of semi-annual or even a monthly pay.
I have a question off the web I want to ask.
Please.
My advisor says, I wrote a lot of long-term care contracts 5 to 7 years ago. Should I look at maybe replacing those, or should I keep them?
That is an excellent question. And I will caution that anytime you think about replacing an existing long-term care solution, that you do your homework. Check and see what's available in today's market. Let's take a look at what benefits are currently in place and what that premium is. When you work with specialists, you can truly do a side-by-side to see, is it more advantageous to replace it? 99% of the times, the individual is better off staying right where they are.
Okay, so really, we haven't had really advancements in pricing that would make it something, what I would say from a financial point of view, to look back at some things we've written 5, 7 years ago.
Yeah, I would say because of the benefits that were available then, like unlimited lifetime coverage that are not available today, you're better off most of the time staying right where you are.
Well, that's our show for today. Remember, before moving forward with any of the ideas you hear on our show, always consult your tax advisor, legal counsel, or broker-dealer compliance department. Missed an episode? You can view all our past episodes at downtobusiness.ashbrokerage.com. And remember, you could be wiser as an Ash Brokerage advisor. I'm Steve Savant. We'll see you tomorrow.